Withdrawing money from a Roth IRA, penalties and rules. These are the Roth IRA withdrawal rules that thousands of Americans get wrong every year, costing them money and penalties and taxes they never saw coming. This video covers exactly when you can pull money out of your Roth IRA without losing a cent, and exactly when the IRS will step in and take a cut. A Roth IRA is one of the most powerful retirement accounts available to American workers. You contribute money that has already been taxed, which means when you withdraw in retirement, the growth comes out completely tax-free, not reduced, not partially sheltered, zero taxes on the gains. The numbers reflect how seriously people are taking this. The average Roth IRA balance across all age groups sits at $106,073, with a median of $32,723. Younger generations are leading the charge with 94% of Gen Z investors putting money into a Roth account, followed by 68% of millennials and 60% of Gen Xers. For 2026, the annual contribution limit is $7,500 for anyone under 50 and $8,600 for those 50 and older, which includes an $1,100 catch-up contribution. In 2025, those numbers were $7,000 and $8,000. Not everyone qualifies to contribute directly. Single filers with a modified adjusted gross income above $168,000 in 2026 cannot contribute at all, and the phase-out begins at $153,000. For married couples filing jointly, the phase-out runs from $242,000 to $252,000. One distinction separates people who withdraw correctly from people who get hit with unexpected bills, and that distinction is the difference between contributions and earnings. Contributions are the money you personally deposited into the account. Earnings are the investment growth sitting on top of those deposits. These two categories play by entirely different rules, and mixing them up is the most expensive mistake a Roth IRA owner can make. Contributions can come out at any time, for any reason, with no taxes and no penalties attached. No minimum age, no waiting period. If you deposited $20,000 into your Roth IRA over the past several years, you can withdraw that $20,000 tomorrow, and the IRS has no claim on it. That money was already taxed when you earned it, and it stays yours. Earnings are a different story. Pulling earnings out early without meeting the right conditions triggers both income tax on those gains and a 10% early withdrawal penalty on top of that. To withdraw earnings without paying a penny in taxes or penalties, two conditions must be satisfied at the same time. The first condition is age. You must be at least 59.5 years old. The second condition is time. Your Roth IRA must have been open for at least 5 tax years. Both must be true simultaneously, and that second condition trips people up constantly. Someone who is 62 years old but only opened their Roth IRA 3 years ago will still owe taxes on any earnings they withdraw. Age alone does not satisfy the rule. The 5-year clock starts on January 1st of the tax year for which you made your first Roth IRA contribution. That timing detail matters more than most people realize. Open a Roth IRA in April 2026 and designate the contribution for the 2025 tax year, and the clock started on January 1st, 2025. That means the 5-year requirement ends on January 1st, 2030, not 2031, effectively shaving a full year off the waiting period. Pull earnings out before meeting both conditions, and the IRS charges a 10% early withdrawal penalty on top of ordinary income tax on those earnings. On a $10,000 earnings withdrawal, that penalty alone is $1,000 gone before income taxes are even calculated. What protects most people without them knowing it is the ordering rule. The IRS requires Roth IRA withdrawals to follow a specific sequence. Regular contributions come out first, converted amounts come out second, with the oldest conversions leaving first, earnings exit last, because contributions always leave before earnings, Many people who withdraw money from their Roth never actually reach the earnings layer at all, which keeps them out of penalty territory entirely. The IRS carved out several situations where you can withdraw earnings early without the 10% penalty applying. Income taxes on those earnings may still apply in most cases, but the penalty itself disappears. First-time home purchase, up to $10,000 lifetime can come out penalty-free for buying, building, or rebuilding a first home for yourself, your spouse, your child, your grandchild, or an ancestor, as long as neither you nor your spouse has owned a home within the past 2 years. Qualified education expenses, earnings withdrawn to cover tuition fees, books, and supplies for yourself, your spouse, or your children or grandchildren are exempt from the penalty. Disability, total and permanent disability, removes the 10% penalty from any earnings withdrawal. Death, when an account owner dies, distributions paid to the beneficiary are not subject to the early withdrawal penalty. Medical expenses, unreimbursed medical costs that exceed 7.5% of your adjusted gross income can be covered with penalty-free earnings withdrawals. Birth or adoption, each parent can withdraw up to $5,000 per child for expenses tied to the birth or legal adoption of a child. Domestic abuse, victims can withdraw the lesser of $10,000 or 50% of their IRA balance without penalty, with the option to repay that amount within 3 years. Federally declared disasters, people living in a federally declared disaster area can take up to $22,000 penalty-free for qualified disaster-related losses, with repayment available for up to 3 years. Substantially equal periodic payments. By committing to a series of equal payments calculated from your life expectancy, you can sidestep the 10% penalty entirely. Those payments must continue for at least 5 years or until you reach 59 and a half, whichever comes later. A second 5-year rule exists, and this one blindsides people far more often than the first. When money moves from a traditional IRA or a 401k into a Roth IRA through a conversion, those converted funds carry their own independent 5-year holding period. Each conversion has a separate clock, beginning on January 1st of the year the conversion occurred. Multiple conversions mean multiple clocks running at the same time, each attached to different dollar amounts. Withdraw converted funds before the 5-year period expires while you are under 59 and a half, and the 10% penalty applies to those converted amounts. A Roth IRA that has been open for a decade offers no protection here. The conversion 5-year rule operates completely separately from the contribution 5-year rule. Put plainly, a 45-year-old who converts $50,000 from a traditional IRA into a Roth IRA in 2026 cannot touch that $50,000 without penalty until 2031, assuming they are still under 59 and a half at that point. Every traditional IRA, every 401k, and virtually every employer retirement plan forces the account owner to begin taking money out at age 73. The IRS calls these required minimum distributions, and failing to take them triggers a steep excise tax. The Roth IRA has no such requirement during the account owner's lifetime. The money can stay invested and growing tax-free for as long as the owner lives. For estate planning purposes, this is a significant advantage. Heirs who inherit a Roth IRA generally receive their distributions tax-free as well, making it one of the cleanest ways to pass wealth to the next generation. The most frequent error is assuming that all money inside a Roth IRA can be withdrawn freely because contributions were already taxed. That assumption is only half right. Contributions can always leave without penalty. Earnings require both the age threshold and the 5-year requirement to be met before they qualify for tax-free treatment. The second error involves conversions. Each Roth conversion starts its own 5-year clock, and someone who converts money in multiple years may have several different clocks running simultaneously, each applying to a different portion of their account, Withdrawing from a conversion too soon means walking straight into a penalty. The third error is underestimating how the ordering rules work in your favor. Because contributions always come out before earnings, many withdrawals never reach the taxable layer at all. Understanding the order before making a withdrawal can mean the difference between a penalty and a clean tax-free transaction. Roth IRA withdrawals follow a clear set of rules once you understand the structure. Contributions are always accessible without cost. Earnings require both the age condition and the 5-year condition to be met before they come out tax-free. Conversions carry their own separate 5-year clocks, independent of everything else. The 10% early withdrawal penalty has defined exceptions for emergencies, major life events, and specific financial situations, and unlike every other retirement account available to American workers, the Roth IRA never forces a single mandatory withdrawal during the owner's lifetime. Know the rules before you make a move, because the cost of getting it wrong is not a small one.